Bitcoin is one software, but also Ethereum is a transactional platform, and Polygon, and HBAR, and Helium, and Avalanche, and all of these other software projects. You know, in 2017, I bought my first positions in Bitcoin and Ethereum. However, if you recall, and I'm invested in many financial services companies that are regulated by the regulator in multiple jurisdictions. So I have to report on a quarterly basis, sometimes a monthly basis. I have internal compliance officers and external auditors, and I also have to file with regulators in the geographies where we do transactions and we own exchanges. Particularly when many of these companies are publicly traded, you simply can't go offside with the regulator. That's not an option. And in 2017, the regulatory environment against crypto was toxic. They were very concerned that the tokenization of assets that were trading not under regulated prospectus, particularly in the New York area, that people were trying to bring debt deals for real estate with tokens, and it was chaos. And my own compliance department said, look, we are getting signals from our lawyers that you simply can't get involved here because these are unregulated securities and breaching securities laws. That's 2017. Fast forward a few years, and all of a sudden we start to see regulators around the world, in Switzerland, in Australia, New Zealand, in Canada, in England, not the US yet, starting to open up to the idea that there's productivity available in not just Bitcoin. Bitcoin is one software, but also Ethereum is a transactional platform, and Polygon, and HBAR, and Helium, and Avalanche, and all of these other software projects. And so for example, in Canada, they were the first to allow an ETF, an exchange traded fund, be traded publicly with the underlying asset being Bitcoin. Obviously, when I see that, I'm realizing things are changing. And I'm looking at our deal flow and saying, look, everybody, I'm a believer in, I've watched the value of my Bitcoin from 2017. It was one of my best performing assets, obviously, and Ethereum. And I said, look, we should start to explore a relationship with the regulators and find out what we can do in the different geographies, because they're going to change their policy at different paces. Right now, the most advanced on earth is Canada. They have just licensed the first crypto exchange tied to a dealer broker. So that's a company called BitBuy. I'm very proud to say that I'm an owner of that. My whole point is, what changed is the regulator changed. They have become far more accommodative. And obviously, I had a chance this weekend to talk to some of the senators here in the United States about their policy, and they're beginning to form committees to start exploring regulating stablecoin like USDC, regulating Bitcoin, regulating Ethereum. You are right. There is a narrative. You're 100% right. The founders of this theory and the founders of the coding and the founders of the first capital raised had very much a decentralized mandate. And that's true. However, let's think about it collectively. All of us that are advocates of cryptocurrencies that have made investments in crypto, they virtually own no crypto. The reason they don't own it is that it's not regulated, and they are under mandates, their sovereign mandates or their pension mandates, to only invest in regulated securities. Now that's the other side of the equation, because if they were allowed to, they would invest. Typical mandate in a $50 billion, $100 billion fund, let me give you an example, would be no more than 20% of the assets in any one sector, and there's 11 sectors in the S&P, and no more than 5% of the fund in any one name or any one company. So when I asked them, how would you like to index for cryptocurrencies? If they could buy Bitcoin, they would put a weighting right now of on between 1% and 3% of Bitcoin. Now, when you have $100 billion under management, 3% is a ton of money. So if you want to see your Bitcoin traded $250,000 or $500,000 a coin or a token, you're going to have to let these institutions into the market. They are the incremental buyers, and they don't trade. They'll buy Bitcoin as an asset and hold it in perpetuity, which makes the whole environment more valuable. You're talking about China banning Bitcoin mining, and there's other countries, including Russia, that are contemplating this as well. And you are right. What is driving this motivation are concerns about ESG. So let me walk you through what is happening with the capital. You know what I like to watch is the flow of capital. Where is it going? Because that will dictate what's going to happen in the mining industry. So 2 years ago, before there was any ESG concerns on Bitcoin mining, when the majority of awards were coming out of China, there was no talk about burning coal to make electricity that was environmentally harming Bitcoin. There were lots of miners burning lots of carbon, whether it be gas or coal or whatever, to make coin, and nobody cared. And then you saw this movement with institutional capital. It really started with BlackRock, the largest institutional manager in the world that does a lot of sovereign wealth, etc. They put out a mandate saying, look, there are certain sectors of the economy that we no longer support. And one of those was anybody burning carbon, particularly burning carbon for Bitcoin mining. And so prior to this, the way that institutions were taking an allocation to Bitcoin mining was they would buy the stock of a company that was trading publicly that was a Bitcoin miner or Ethereum miner or a data center manager, whatever. So they could get exposure to a Marathon or Riot or whoever it was that they decided to take a position in as a proxy for owning Bitcoin. And the way these companies were talking about becoming carbon neutral, at that time they didn't care, but as the pressure came on for ESG mandates, they started buying carbon credits. Well, that's not going to work because you're going to start to see in this year, I'm speculating, that these large institutions are going to start demanding audits, carbon credit audits. And you don't want to be in a company's stock that has the risk of a carbon audit, because the truth is it's almost virtually impossible to show and understand the tracking error of a carbon credit versus what you're actually burning in carbon. So all of the money is quietly moving right now to new mining companies, most of them private, that are going to use hydro, wind, solar, and nuclear power. The biggest question for NFTs, and you're right, it's a very fast-growing asset class, is whether it's a security or not. When an NFT in its smart contract has a royalty associated with transfer of ownership, it is distributing capital. And that generally is interpreted as being a security, no different than a bond paying interest or a stock paying a dividend. But we haven't had a ruling on that yet. More concerning right now is what you said earlier, that there's a lot of scamming going on in the NFT space. So it would be much better for all of us, and I'm a huge believer in NFTs, if we could find some way of providing a new level of security so that you as an owner who have made an investment, whether you've done it on a centralized or decentralized wallet, should have some sense that there's security and an auditable position and a path to understand, when something does go awry or it's been stolen, that there is a way to pursue it. And we don't have that right now. So I would say investments in much more secure wallets and better functioning wallets would expand the NFT space geometrically.